Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
Hey, folks, welcome back. Today, Victor Bell is our guest. He's zooming in from probably my favorite city in California, a beautiful small city just outside of San Diego called Carlsbad. And Victor is an accomplished real estate entrepreneur, focuses on multifamily properties, and we're going to find out what his secret sauce is today. So, Victor, welcome to the show. Great to have you.
Hey, thanks so much for having me, Dave. I really appreciate you. I do.
So, Victor, we're doing this recording the middle of 2026. Give us a little idea of what your portfolio looks like, what it consists of, what you invest in.
Right. So right now we have an open fund. It's our first fund, right? Been doing this for like 30, coming up on 30 years. So we sold off all of our apartment buildings that we had in Hawaii and some single family stuff right before COVID. And then we bought more properties there and sold them. So right now we just have the $50 million fund. It's an actual 506c raising capital. And fortunately for me, right as COVID was happening, we sold the last properties that we did have while we were here, and we just kind of put a pause on buying anything. And who knew the interest rates were going to last longer than it would take to graduate from college. But so but that's from the 28 years of watching the different cycles and saying, hey, maybe it's time to kind of put a pause on this and don't put our investors under any kind of scrutiny while we're still building these relationships. So that's where we are right now. So,
all right. So you got a lot of experience investing in Hawaii. Now that you're stateside, so to speak, you're on the mainland. Where are you looking to invest with this fund?
Right here in San Diego County and Orange County. Just because doing multifamily, like the apartment buildings in Hawaii, has a direct overlay to San Diego. High barriers to entry, low cap rates, bunch of red tape. So it is the perfect mixture of the right market for somebody who knows how to play in those markets. And that's what I did over there for 17 years.
Well, that's really interesting, Victor, because almost everyone I interview from California loves living in California, except for taxes and whatnot, but do not invest in California, especially multifamily. They don't like the landlord tenancy laws. They don't like the socialistic leaning government. They don't like all of that stuff, the price tag to get in there. But you're absolutely right. I mean, my limited knowledge, but Hawaii's just as bad, maybe worse in certain aspects than California. So tell me a little bit about that counterintuitive thought process you have there about investing in these markets that other people just don't want to touch.
Well, because of it, between the high barriers to entry, you figure, and you've been here, you got ocean on one side, mountains on the other, real estate in the middle. You got constraints, so you have a supply and demand issue. It takes a lot for anybody to get permits, and it takes time. The cost to buy these properties, meaning the equity piece that you have to come up with, tends to be somewhere around 40%, 60%. And it's not a heavy cash flow market. Neither was Hawaii. So you're really depending on the fact that no one's going to be able to come in and play the game. And naturally on your exit, your cap rates are pretty much going to be somewhere around 4 or 5 on the average. And that's a better place for appreciation. So the people who tend to play the markets this way aren't really playing the buy low, sell high. They're playing the buy high, increase revenues and income because of they're not going to have a whole bunch of people come into play. And as it relates to the rent controls, that's okay too, because I'm not in LA County. LA County is very heavy with that. San Diego County and Orange County are not. So that's also the distinction. It really is a better market to play because, I'm sure you've seen it as well. California has I think it's like the 4th highest GDP. So a lot of capital comes from here and then it leaves and goes someplace else when the market does what it's you've seen it do over and over again, for a lot of investors see it as well, it gets trapped in these other markets and they leave their good properties where they made the money unattended. So people who live in these markets buy them. They buy them at a discount because they have to exit because you don't sell your bad properties, you have to sell your good ones. It's kind of what it is. You know,
Okay, interesting.
yeah.
Yeah.
So I learned that pretty heavily in Hawaii because a
Yeah.
lot of money came to Hawaii. They made money. They went to Texas. They went to Houston, which is where everyone goes, Ohio, North Carolina, Florida. And then when the market tanks, they can't sell or they lose their money and they have to come home. But by that time, the locals have bought the properties. So,
So let me see if I understand what you're saying, Victor. So basically, you're saying all these other hotshot real estate investors and multifamily investors in California, they might have made their money in California. They got enticed by some of these sexier markets. They took all
yeah,
their money and invested there. Things have gone tits up, excuse my French, but they haven't gone too well for
yeah,
them
yeah,
in those
exactly.
markets. So now they
Hmm.
have to come back home, but other guys like you have scooped up the properties or they have to sell them because they're in financial dire straits. So is that where the opportunities are coming from?
Exactly. That's we call it, it's about sacking York. If you can sack York, you win. So,
Okay.
so
Yeah.
if your soldiers are gone and your city gets attacked, you have to come home and integrate with the new city. And I've just seen it happen. I'm originally from Texas, so I bought in a lot of different markets other than
Okay.
Hawaii, and it's just been this same thing. Texas is a boom and bust city, state. Austin,
Yeah.
Houston, Dallas. A lot of people come there. It shuts down and gets slow because there's a lot of opportunity, and they have to go back to where they left to make the more money. But by that time, the Texas owners buy their properties back. The people from California that never leave buy their properties back, and then the cycle starts again.
Yeah.
So when you know that, because when
Yeah.
I say it, it makes sense, right? Like
Yeah.
other
Yeah.
people
Yeah.
like, huh, I didn't think about that. But where does the money come from in general? New York, California. And if you can just go there at the right time and not get caught, you can make it. And I've been fortunate about that.
So, Victor, you've been very, very patiently sitting on the sidelines for years.
Mm.
My goodness.
Yes,
That must be a little bit frustrating at times, I would think. Or no. Or you just kind of
very.
patiently, kind of like a spider in the web waiting, waiting patiently for the fly to kind of
Yeah.
arrive or something like that. Yeah.
Yeah, very. And the problem with that is, well, let me say this. I'm a very patient investor, anyways. Patient yet persistent because it's not like I'm not going after deals, but as I look at what's going on, I'm like, I hate losing money. Like I don't
Yeah.
gamble, I don't want to lose a dollar. Not that, I mean, you have to take risks to make money. But the challenge is that in this business, and I'm sure and people who listen, if you get the wrong multifamily apartment building, like stuff we look at is 50, $70 million, assets. So you can't turn that ship very quickly. You can turn a
Hmm.
dinghy, but you know, if the Norwegian cruise ship leaves, it's going to take a bit to circle back.
Yeah.
And while that's happening, you watch these bigger firms, Blackstone, like these bigger firms they didn't capitalize on the markets either. They waited, like Brookfield. They waited. So, and you know them as well from being from where you are. So when you take a look at that, you're like, well, they're not stupid. They have more money than God. And if they're
Hmm.
waiting, some of the little guys that you see didn't wait. A lot of my investors that, we've kept relationships like, hey, we're gonna wait, be patient. They're like, hey, I'm thinking about this deal. What do you think? And I was like, you can do it. I can't tell you what to do. And now they're like, hey, Vic, we lost our money in that deal. I should have listened. And I was like, yeah, I would have loved to take your money and throw down on a deal, but the problem is it's not whether I can get it, is can we get out and
Yeah.
to what extent?
So,
So
so,
yeah, it's
so
tough.
Victor, you're in the midst of raising for a fund. Did I understand that correctly?
Yeah.
Yeah.
Yeah. Yes.
So, if you don't mind sharing, like how is that going? How are you finding investors with that really patient money that are willing to wait years and years until you find that really good deal?
Is a lot of it showing them what we're looking at.
Yeah.
So it's kind of like, like, hey, here's the deal we're underwriting. Here's what we're looking at. And some of them have already dog-eared money and said, hey, I got the commitments because I'm not going after people who don't have consistent revenue in a business. Typically,
Hmm.
my investors are business owners, high net worth people. They have revenue, and some of them have other assets already playing. So they're either going to invest with me or someone else. Unfortunately, maybe like you said, it's like they're like, you have something, and I'm like, yeah, but what I didn't want to do is get in a situation where this being a first fund, not a first time deal, turns out to
Yeah.
be a losing fund. Unfortunately, unlike the S&P, I can't just take my ticker off and
Right.
replace it with something else. Yeah. So
So,
that's
how
been
does
an
how
interesting
does that
approach to do.
work, Victor? Do you have funds in the fund already, just kind of sitting
No,
waiting, or
no.
no? Okay.
We did soft commitments and commitments. So what we did was we just did the commitments and we just stayed in touch with our investors. So in any
Okay.
deals I did outside of the fund, there was a personal, but they were not fund related
Hmm.
because it was a lot easier to do that because I also know people who do started funds and were switching to syndication out of syndications into funds that had to give capital back.
Hmm.
So
Right.
that's another problem. Like you take money, you can't get a deal, or the deals don't pencil because you don't want to push it. Now you have to pay your investors back plus some interest on your money that you really didn't make.
Yeah.
And they're probably not going to give it to you the second time. So, it's costly, but yeah,
So, if I'm understanding correctly, you've got a bunch of investors who have given you soft commitments or
yeah,
verbal commitments to
yeah,
invest in
yeah.
the fund. So now you're looking for opportunities, you're looking for deals.
Hmm.
When you
Hmm.
find one, then you're going to say, "Hey, everybody, we're ready to go. Put your money
Yeah.
in the fund at this." Is that pretty much how that works?
Yeah, yeah, that and during the time of looking for regular investors, I also look for what I call anchor investors. I mean, we all call them that. It's just somebody who has a big enough balance sheet to where if we found the right deal, like a 50 to $60 million deal, we can go and close that deal and then backfill it with the fund
Okay.
over the timeline.
So you
So
got some
there was
short-term
a lot of
options there.
yeah. Yeah, there was preparation in this. It wasn't like a mindless, well, we're not going to take money, let's just wait. And then also, like I said, that's and we go right back to moving into a different market. A lot of it was relationship building with brokers. I mean, because the brokers that we're
Right.
dealing with are CBRE, JLL, Cushman, not Cushman, but Walker and Dunlap, because Cushman's not big here in Hawaii. Like I got a relationship there. And just getting some of those brokers to call you back when they don't know you,
Yeah.
could take some time, right? Because they're going to go to their independent as well as they're trying to eat as well in a market
Yeah.
where
Yeah.
nothing's
Yeah.
moving. So there was a lot of those things and a lot of the re-education on some of the investors who were used to, hey, I'm going to invest in this deal. We're going to get our money back. This is long term. Markets turned. A lot of people haven't seen what's going on right now in any real estate cycle.
Right.
And I'm sure you have over time, doing what you do too.
Mhm.
So it was a lot of preparation for that, telling my investors to be patient. So, and some of them weren't. And I've lost some commitments because of it. I talked to a guy yesterday
Yeah.
who was like, hey, we had 300,000 another deal and all of their equity got lost in that deal.
Wow. Wow.
Yeah. That
Yeah.
sucks.
It's tough times. It's tough
Yeah.
times for a lot of folks.
Hmm.
All right. So as we're wrapping up the conversation, Victor, what do you see your buy box being? What properties, what particular cities are you looking at? Like what size properties, what vintage, that ideal?
Well, what our buy box is currently, we're looking at class A to class B plus properties, newer assets,
Okay.
10 years and younger, 10 years old and younger in San Diego County and also in Orange County as of late. So newer stuff. Typically, right now for the fund, we're targeting distressed sellers, not distressed assets, nicer properties, because we know we're going to get the same returns on a newer
Mhm.
asset that doesn't have the rent control constraints. They're going to be in a better location. We're probably going to be the first or second owner operator of the asset, as opposed to something that's 20, 30. I always said no one wants to date an old woman or an old man. So by the time we get, 30, 40-year-old deal because of the markets that we're in 10 years from now, it'll be 50, 60 years old. And do you still
Right.
want to own that asset? So that's typically a buy box for us, something that if we were to have four or five properties all in one as a in one deal or a couple of funds, we can turn right back around as the market changes and sell them to a potential institution or, a small hedge fund or anything like that. That's the goal, at
All right.
least short term.
Very good.
Yeah.
And these days, Victor, who are you looking to connect with?
Always investors, people with a good attitude. I love talking to people with great attitudes who are just nice to work with. Naturally, investors, accredited investors, or just people who are looking to have conversations about the market, how we can help each other and share. I love this business. This is a people business.
Yeah.
So anybody that's kind of along those lines. So GPs, LPs, good people.
Nice. And Victor, if people want to connect with you, what's the number one best place for them to do that?
That is, they can go to my Instagram, at the real Victor Bell. That's perfect for us. Or you can always find me on LinkedIn at Victor Bell as well. But the Instagram one is probably the best. It's at the real Victor Bell, and you
Very
can
good.
see my smiling face there.
Hey, Victor, thanks so much for being on the show. And that's fascinating. Hats off to you. That I love anything that's kind of counterintuitive, and definitely what you're doing in that market is not the norm. So hats off to you for getting that really dialed in and having that track record in Hawaii, which is a very, very similar kind of market that way. So thanks for explaining what you do.
Yeah, thanks for having me. I really appreciate you, Dave. I love what you do. Thanks for doing what you do, and thank you for being successful at it. I appreciate you.
Oh, thank you. All right, everybody. Take care. We will see you on the next one.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviews.com.